In this presentation, we will take a look at multiple choice questions related to managerial accounting decisions, managerial accounting situations, going through those questions and then practicing test taking skills with them. First question. We have a machine with a book value of $70,000 and a remaining useful life of 3 years. At the end of 3 years, the equipment will have a zero salvage value. The market value of the equipment is currently $40,000. We can purchase a new machine for $160,000 and receive $30,000 in return for trading in the old machine. The new machine will reduce variable manufacturing costs by $40,000 per year over the 3-year life of the new machine. The total increase or decrease in net income by replacing the current machine with the new machine, ignoring time value of money, is either A, B, C, or D. So if we see a question like this is obviously a very long question in terms of the text. We would probably say, there's numbers involved up here. I see numbers in the answer. We're going to have to do some types of numbers calculation. Let's skip to the last sentence and see if I can figure out what they are looking for. Drilled in down on that as we read through the questions, jotting down relevant information as we go. So the last sentence, the total increase or decrease in net income by replacing the current machine with the new machine, ignoring time value of money. So it basically tells us what we're going to do right there. We're going to have a machine problem. We've got an old machine. We got a new machine. The question is, should we replace the old machine with the new machine? That's a typical kind of managerial accounting question. We know the scenario now. Now we'll go through the facts, and we want to look at those relevant costs related to them. Typically, when we have a problem such as this, the main trick to this question is basically to be able to understand and realize that the cost of the old machine, which is given here as the book value, and basically the salvage value or any kind of depreciation that they might be saying on the old machine, the point is that those are sunk costs. Those are not relevant. You would think they would be relevant. You'd think, hey, there's a value on the books of the 70,000 or book value. We need to do something with that with regards to the decision-making process. But again, we're talking about this point forward, cash flows related to this point forward. Now, also note that we're talking about ignoring time value of money because this is not a time value of money question. Doesn't mean it's not irrelevant in that obviously time value of money is a different kind of factor that we want to play into it. However, we need to understand this factor first and then consider the time value of money, which is the fact that there's a sunk cost. We need to think about the relevant costs over a time period. Because there is a long time period, then of course time value of money could be a factor within it because it's going to be affecting multiple years. Okay, given that, we're going to say we have a machine with a book value of $70,000 and a remaining useful life of 3 years. The $70,000 not material here. We're talking about a 3-year time span. At the end of the 3 years, the equipment will have a zero salvage value. The market value of the equipment is $40,000. Again, not relevant, except that if that's the number we need to use in order to sell it at this point in time. But they actually give us another sales number, so whatever the estimated market value isn't relevant. What we can actually sell it for is what is relevant, and if that might be the market value in some questions, right? So here we keep going. We can purchase a new machine for $160,000. So the question is, should we get the new machine? It's going to cost $160,000. I'm going to put that here with a negative. So $160,000 outflow or negative, and receive $30,000 return. So this is the salvage value. So we can get $30,000 if we sell the other equipment, or basically whoever we're purchasing from maybe said there's a trade-in, we'll give you $30,000 for the old equipment. So I can say, all right, $30,000 for the old equipment. The new machine will reduce variable manufacturing costs by $40,000 for 3 years. So this is going to be what we're going to get over the next 3 years. We're going to have increased efficiency. Let's call it increased efficiency. Okay, I just spell checked that, so it should be spelled closer to something correct now. Okay, so now we're going to say that increased efficiency is going to be $40,000 times 3 years, right? 3 years, because that's going to be the useful life that we're going to have of this that we're comparing it to. Now, again, if we were taking time value of money, of course, the $40,000 in year 2 and year 3 would be valued less given the time value of money. That's not our point right here. Our point is to consider these as relevant costs as opposed to those that aren't relevant, including the book value and the depreciation. Okay, so then we're going to say, all right, let's sum these up, which is this minus this cost, and then the inflow and the savings. And of course, the cost then, in this case, not of course, but in this case, the cost is higher than the savings. Now note, again, if we took time value into case, we might do a quick kind of calculation such as this, relevant costs, and if it's something that is still seeming plausible to us, we might then break this down to time value of money, and we might also include things like taxes, which would include the cost of taxes, which includes depreciation as an expense into this type of calculation. But here we're saying relevant costs doesn't look like it's a good thing. Looks like we want to keep the old equipment here. It's going to cost more than the savings given the relevant costs. So the final question is the total increase or decrease in net income. So the net income is going to decrease by the 10,000. So it looks like A is the answer. 10,000 decrease versus 10,000 increase. We had a decrease, and then these other numbers don't seem to apply out in any way. All right, next question. We are considering eliminating a division which reported an operating loss for the current year of 100,000. The division sales for the year were 1,500,000 and the variable costs were 1,200,000. The fixed costs of the division were 400,000. If the division is dropped, 40% of the fixed costs allocated to that division could be eliminated. The impact on operating income for eliminating the division is, we've got these numbers down below. Again, if we look at a problem like this, we would probably see numbers in it first. We might want to glance at it, say, I see numbers. I see numbers in the answers. Looks like a calculation problem. Let's look at the last sentence and see what they want to calculate before possibly reading through the problem. So we go through it and say the impact of operating income for eliminating a division. Notice it tells us everything we would need to know about what type of problem this is. We're going to eliminate a division. What's going to be the effect on income? That automatically would start us thinking, okay, I would assume the scenario for a book problem is going to be that there's a loss reported on this division and that we need to figure out if that loss is accurate given the allocation of costs as opposed to the cost that would still be there. So in other words, the question is going to be, although they have a loss being reported with costs that are allocated, it may not be the case that those costs would go away if we were to eliminate the division, and that's going to be the relevant factor in this. So we're going to say, all right, let's do the calculation. So if we go through this again, we are considering eliminating a division which reported an operating loss for the current year of 100,000. Now they might not even include that. They might have us calculate the fact that it has a loss, but we would consider it would because that's why we're thinking about closing the division. So the division sales for the year were, so we're going to say, all right, sales are 1,500,000 and current variable costs are going to be 1,200,000 for that division. The fixed costs of the division are 400,000, so 400,000 on the fixed costs. So if we were to say the sales minus the variable cost minus the fixed cost, we would get to what we would expect, that loss of 100,000. So there's the 100,000 loss. So obviously looking at this, we would say, hey, this division losing us money. Why are we even keeping it open? Why don't we close this division? It's not helping us. It's hurting us. We would save 100,000 if we were to do so. However, we know that these fixed costs, it's always going to be the component that we're looking at, the fixed costs, are partially allocated. So the fact that they're allocated is good for some calculations, not good for the determination as to whether we should eliminate the department or not, because we're saying if the division is dropped, 40% of the fixed cost to that division could be eliminated. So we could only eliminate 40% of these 400,000. Those are the only relevant costs here. So of this 400,000, we could only eliminate 40% of them. So if we do this calculation again, it's saying, okay, the fixed costs are only 160. So if I took the sales that are relevant, the ones we can get rid of, the ones that matter for this decision, minus this, we're going to say, no, they're actually contributing to our profitability by 140,000. The fact that they have a loss is because we allocated income to them. And you might say, well, why would we do that? How would we do that then? We do that for other types of decision-making processes, and that's the problem with fixed and variable costs. So it's useful for us to allocate costs for some decisions, not for others. And so we have to keep in mind for a decision such as this, that if we cut this division, we would actually be losing money, given the fact that we wouldn't be eliminating all these fixed costs, even though we're allocating them to that division. So we're going to have 140,000. So the question being, so we have two of those, of course, here. The impact on operating income for eliminating the division. So operating income, if we were to eliminate the division, would actually decrease the operating income, which is what we don't want. So we don't want to do it. So it could ask the question, should we do it or not? No, because it's going to decrease the operating income for the 140. And remember, for this type of problem, this is the outcome that we would expect for most questions, because it's the one that emphasizes the point. There's a loss, it looks bad, but then when we do the calculation, the division is saved, not because it's a good story time and we're happy to save all those jobs and whatnot in our problem, but because that emphasizes the point that we've got to go through this allocation process, and this would be the best scenario to show that point.